Aloha and welcome. I'm Stephen Bond-Smith. In this UHERO focus video, I'll update you on our second quarter outlook for the Hawaii economy. In our previous report, we highlighted that emerging federal policies created significant risks and uncertainty for Hawaii's economy. In Q2, we now have new policies in place, but the picture isn't any more certain. Big policy shifts are underway on trade, on immigration, and federal spending. The announced tariffs were far larger than expected. Some changes are already in effect, while others are paused with the decisions pending. But many policy changes are being challenged in court, and all of this creates significant uncertainty. So let's take a closer look at what we now know and what it may mean for Hawaii's economy in the months ahead. Across the US, growth has cooled. Retail spending surged briefly in March, but that seems to be preemptive before the tariffs took a hold. Broader consumer spending has flattened, and first quarter GDP may have even contracted slightly. The slowing of the economy is driven in large part by the effect of the new federal policies on business and consumer sentiment. The tariffs announced in April were among the largest in over a century. And while some of the higher rates have been paused for 90 days, a 10% universal tariff is now in place, and tariffs on China have risen to 145%, with some items facing combined rates of up to 245%. In addition, cuts to federal spending are beginning to affect not only federally employed workers, but also those supported through grants and contracts, particularly in research, education, and social services. Tourism started the year on solid footing. Visitor counts were up, especially on Maui, which was welcome news, and hotel performance improved in most counties. But the outlook has weakened considerably. We now expect visitor arrivals to decline 4% over the next 2 years, led by sharp declines in international travel, primarily affecting Oahu, but Canada is also a vital market for Maui. The decline reflects growing unease among international travelers, driven by policy concerns like tariffs, stricter entry vetting, and as a result, forward bookings have slowed. Domestic visitors will be facing tighter budgets and a slowing US economy in response to tariffs, and with a rising risk of recession, they are also likely to reduce domestic travel heading into 2026 and 2027, which will add to the decline, but especially on the neighbor islands who depend more on US visitors. Hawaii's construction industry continues to boom, driven by public infrastructure, military investment, and Maui's rebuilding. Construction employment has grown 2.4% over the past year, faster than any other major sector in Hawaii. Activity will stay high for now, with major projects underway, but we're nearing its peak. Construction employment will top out near 40,000 workers, followed by a gradual decline in 2026 as new contracts slow. But tariffs on steel and other building supplies are raising costs, and the uncertainty around future tariffs makes planning harder. And in Hawaii, long construction timelines amplify that uncertainty, and potential projects may be delayed until the outlook stabilizes. Speaking of tariffs, our forecast for local inflation has increased in the near term. This is driven by housing, food, goods that are all going to be affected by tariffs. Prices rose 4.4% last year, and we expect inflation to stay above 4% through 2026. Federal policy remains one of the biggest sources of risk for Hawaii, and so far the state has lost about 300 federal civilian jobs, but larger cuts are on the horizon. UHERO projects a net 2,400 positions statewide will be lost, but the impact doesn't stop with federal payrolls. More than 3,300 state employees are funded through federal grants, along with hundreds more in county government, education, and nonprofit services. Well, not all of those jobs will be cut. Those jobs are now considerably more uncertain as the federal budget tightens and new contracts are delayed or cancelled. For now, Hawaii's overall labor market remains strong, but as federal job cuts deepen and tourism and construction activity begin to ease, job growth is expected to slow, with outright declines in 2026. So where does that leave us? We now expect Hawaii's economy to enter a mild recession later this year and going into 2026. GDP growth will slow in both the US and Hawaii, but with Hawaii's already low growth rate, the slowdown tips us into a recession. Job growth is projected to stall as federal cutbacks and rising costs, along with weaker visitor spending, take hold. The strength of construction will cushion the downturn, but tourism, public services, and household spending are all under stress. And with many major policies in constant flux or being challenged in court, uncertainty remains elevated. You can read our full forecast in our report at UHERO.hawaii.edu, where we discuss these uncertainties in more detail. Mahalo for watching, and we'll see you next quarter. Aloha.